Acento is a real estate investment and operating management company in business since 2002. We create value for institutional and private investors, primarily from Latin America, who want U.S. rental real estate in their portfolios. Acento's main priorities are protecting capital and minimizing return volatility. We invest in defensive assets and work extensively to produce returns within a predictable range. Acento has managed just about $1.4 billion in multifamily assets, producing an aggregate IRR of 15.4% in about over 2 decades. Our primary focus is and has been workforce housing multifamily with concentration along the Eastern Seaboard. We generate sustainable financial value for our investors through sound management practices that take care of our assets, our communities, and the environment. We achieve this by acquiring defensive, cash-flowing, US-based multifamily real estate. Our investments undergo strategic redevelopment that allow us to increase operational profitability through proven management practices that support the communities we serve while improving both value and cash flow for our assets. In partnership with BTG Pactual, we launched and developed Specialized Multifamily Partners Fund 1, which opened in 2019 and is now materially invested.
Specialized Multifamily Partners 1 investment objectives are driven by pursuing 3 key components: capital preservation, yield, and capital appreciation. We achieve these goals by acquiring and managing workforce multifamily housing. Over the past 30 years, the multifamily real estate sector has consistently outperformed many other sectors given its resiliency and strong fundamentals. Despite the recent economic shocks, the multifamily sector has proven to be one of the strongest real estate sub-asset classes with sustained healthy occupancy levels, robust rent growth, and providing performance for investors during turbulent economic times. Recent increases in home prices and mortgage rates have heightened demand for rental properties due to a critical shortage of quality affordable housing for renters in the U.S. This imbalance between rental demand and supply contributes to stability in rent prices and the opportunity for consistent growth in net operating income for investors. The workforce multifamily sector is positioned to maintain this trend over the long term. Furthermore, real estate investments exhibit a low correlation with traditional asset classes, such as equities and fixed income. These characteristics position real estate as an effective portfolio diversifier, offering investors strong risk-adjusted returns and a stable investment environment. Additionally, when seeking loan financing for multifamily properties, Fannie Mae and Freddie Mac, also known as agency lenders, provide more favorable terms relative to conventional financing, including a consistent source of capital, advantageous rates and proceeds, especially for workforce housing, flexible loan terms, non-recourse financing, and assumability. Our strategy targets markets with a significant Hispanic population, a community experiencing robust growth, reliable rental payment habits, and strong purchasing power. The U.S. Department of Labor reports that Hispanic individuals accounted for 39% of GDP growth, despite representing only 19% of the population. Since its inception in 2019, Specialized Multifamily Partners Fund 1 has delivered robust results. Originally, S&P aimed to raise $350 million. We surpassed this goal by approximately 118%, finishing with total commitments of $412 million. Today, the fund currently encompasses 22 properties, totaling approximately 6,000 units, with an average occupancy exceeding 95%. All this enabled us to provide a 7.04% annualized distribution in the last quarter, with current projections estimating an investor return of approximately 10.75%. Our performance remains robust, even amidst an uncertain and volatile global economic landscape.
We acquire assets that provide a stable and sustainable income stream. In order to better manage risk and properly plan for the future, Acento takes over property management responsibilities. We focus only on managing our own properties. This intense focus ensures world-class service, that enhances investor returns and aligns investor interest with day-to-day operations. Acento invests in assets in which we can enhance property value and enhance investment cash flows while also supporting healthy workforce communities.
To enhance property value, in other words, to drive asset appreciation and cash flow, Acento implements effective management strategies and sustainability initiatives. Acento believes that both environmental risks and social well-being are investment risks in today's environment. By adding environmental and social initiatives to our economic thesis, Acento can better deliver predictable returns that are competitive and resilient. Our multidisciplinary approach allows us to create long-term value and position our company as a leader in our space.
We seek to generate sustainable financial value for our investors through sound management practices that take care of our assets, our communities, and the environment. Our impact strategy is built around 5 shared value initiatives: electrical energy efficiency, gas consumption efficiency, water efficiency, diverted waste, and tenant quality of life. Acento's environmental property efficiency and tenant quality of life initiatives are projected to increase occupancy rates to 96.4%. Projected utility savings per unit via solar panels, LEDs, energy point measurement, water reduction, and energy and waste efficiency initiatives, in addition to better living conditions, will increase Acento's rental income. These initiatives are projected to reduce turnover rates to 26.4% and to reduce repairs and maintenance cost by 4%, enabling us to continue to significantly outperform the real estate sector. Through these initiatives, we are taking decisive steps to ensure that our sustainability efforts continue to advance, delivering both environmental and economic benefits for years to come.
These initiatives are anticipated to drive value creation across 4 key performance indicators: rental rates, occupancy, turnover expense, and maintenance costs.
In continued partnership with BTG Pactual, we are excited to announce the launch of our new investment vehicle, Specialized Multifamily Partners 2. This new investment fund continues to invest in our proven strategy focused in workforce housing located in areas with significant presence of Hispanic demographics. Our goal remains focused on strong cash flows and long-term capital preservation and appreciation. This investment strategy is characterized by holding a moderate risk profile supported in diversification, operational efficiencies, and resident retention. Ultimately, we will implement our proven strategies to create value operationally and offer attractive and competitive returns. We aim to raise a minimum of $600 million with Specialized Multifamily Partners 2, which is a continuation of our joint venture with BTG Pactual. As general partners, we will invest a minimum of $20 million or 3.5% of commitments, assuring our alignment of goals with those of our investors. With target returns of 12 to 15%, SMP2 will deliver profits for this 10-year fund via quarterly cash distributions that make up 2/3 of overall returns and capital appreciation captured at asset sales. In SMP2, we look forward to generate value for our investors under this proven investment thesis.